Hi, I'm Alexis Christoforous, and this is Yahoo Finance Presents. We are at the New York Stock Exchange, where I sat down with President Stacey Cunningham for a far-reaching conversation. We spoke about tensions rising in the Middle East and what that could mean for the stock exchange and for investors. We also talked about the state of IPOs in the year 2020. What might we expect, and our more direct listings, the way Spotify and Slack chose to go public, in the offing. We also talked about consolidation in the brokerage industry and what that means for Stacey Cunningham's company. And we also take a look at how the exchange is staying relevant in the digital age. Also, Stacey Cunningham has a passion for cooking. We touch on that. And we take a look at what her life hacks are. That and much more in our conversation. Stacey, thanks so much for being with us. We appreciate your time.
Thanks, Alexis. I'm excited to be here.
All right, so the new year began with escalating tensions between the U.S. and Iran. There have been lingering concerns about further retaliation from Iran that perhaps could come in the form of a cyber attack. What, if any, unique security precautions are you taking here at the New York Stock Exchange?
I think if you take a step back and you think about what we have to do, we have to be ready for markets to react to whatever's happening at any point in time. So we're always making sure our systems are secure and our systems are ready for market conditions to change. And that doesn't just apply to the trading activity, it also applies to cyber risk. So that's something we spend a lot of time and energy on, and that's a daily thing.
We are sitting here on what is called the Members Gallery of the New York Stock Exchange, which is really considered by many the very core and symbol of capitalism. And in many ways in this election year, capitalism has sort of come under fire. When you look at a lot of the Democratic debates, more progressive sort of socialist-leaning ideas are out there, candidates are out there, and for some, capitalism has become a bit of a dirty word. What can the New York Stock Exchange do and its member companies do to address those issues?
So I'm glad you bring this up, because this is an issue that I'm personally very passionate about, and it's certainly an issue the New York Stock Exchange is also passionate about. Capitalism has really been the framework that has built the success of this country. And I think there are a couple things we should just consider. When I look at the mission of the New York Stock Exchange, it's been to help companies raise money so they can go out and change the world. But importantly, they're creating jobs along the way, and they're allowing investment opportunities for others to share in that success. Where I think we've seen a bit of a pivot, largely because there's so much access to capital outside of the public markets, we're seeing some of those companies wait to go public. And when they do that, it means that not everyone gets that same benefit to plan for their futures and share in that success. So where I think it's important for us to focus our energy is making sure that the everyday investor has access to the broadest opportunity set possible, so that they still understand why they benefit from capitalism and why that's been good and so important to the success of this nation.
Do you think that the messaging is on point from places like your exchange, from publicly traded companies, about the good they do and how they do contribute to society?
No, I think we've taken it for granted, and I don't think we've done a good enough job telling the story about all of the good work, the companies that are listed here. There are almost 2,300 listed companies on the New York Stock Exchange. They employ 45 million people directly. Those are jobs that are being created because they're able to raise money to scale their businesses. That's important. Aside from jobs, those employees often have 401ks that they're investing in. So you don't have to think about the markets being not for you. You know, very often it touches you in indirect ways where you may not realize. And I do think it's upon us to tell that story, to highlight not just the jobs that are created or the investment opportunities, but also the good work that all these companies are doing to give back to their communities. Their focus on sustainability and governance and how we can actually make ourselves a much stronger nation, because the corporate CEO has a much stronger voice than they've had historically.
Absolutely. You know, we're talking about an election year, being in an election year. Is there anything, a message you'd like to send to Congress in terms of legislation you'd like to see either enacted or perhaps even rolled back that you think would benefit the exchange and also investors?
Yeah, I think what's important to recognize is that additional requirements we put on public companies should be focused on investor protections, but we should not put requirements on companies that are public that we don't put on private companies too flippantly, because there are consequences to any legislation. Many of the very well-intended legislations that we've seen have become burdens on public companies, and because there is an alternative to being public, I don't want to see companies just decide not to access the public markets, which means investors don't have access to them. And so very often if we're doing things that we think investors might want to see us do, but at the same time investors would lose access entirely, we just need to retain that balance. And I think that what an important word there is balance. Balancing investor protections with investor access, balancing issuer flexibility, so company flexibility to run their businesses, while still providing enough information for investors to make informed investment decisions. Those are the kind of themes that we're thinking about all the time.
Is there legislation on the books right now that you can point to that is a little too burdensome, you think, for these publicly traded companies?
Yeah, I think when you look at the disclosures, and around quarterly reporting is certainly an area we've been focused on with our listed companies. And I'm not advocating for less frequent reporting, but we do think that we should be revising the amount of labor that goes into the quarterly reporting cycle. How can we streamline to make sure investors are getting the information that they need without having to file a whole phone book each quarter and all the work that goes into that, so management can focus on their businesses? There are also some components of the Jobs Act that may have had some unintended consequences on keeping companies private much longer. For example, the number of employees or the number of shareholders that you have that forces you to go public is increased broadly. So many of the tech companies now are waiting to go public because they're not hitting that trigger.
Mm-hmm. One of your member firms, J.P. Morgan, the CEO, Jamie Dimon, has been very vocal about saying, we don't need these quarterly earnings reports. Maybe we report once a year. Do you agree with that?
I think what Jamie has talked about is more around guidance, right? Providing some forward-looking statements around what companies are going to do. And so I think having transparency is critical, right? We investors need that transparency so they can make informed decisions. I think guidance is more subjective, and different companies have different views on that, and that's where the debate has really been sitting. I frankly think if we can streamline the process around reporting, you won't see so much opposition to the frequency.
You're talking about publicly traded companies versus private. Congratulations, because the New York Stock Exchange once again was first in terms of capital raising last year. Nearly $112 billion in proceeds raised, mostly from IPOs. What does the IPO pipeline look like? I know we're early in the year, but what does it look like right now?
Yeah, I think each year informs the next year in some way. And so in 2019, what we saw was really a mixed bag when it came to IPOs. Early in the year, the government was shut down. So there were no IPOs in the first quarter. It's hard to
right. It seems like a very long time ago.
But it was just a year ago that the government was shut down. Fast forward to the second quarter, it was very busy from the IPO in the IPO market because there were so many companies that had queued up, not just coming off of the shutdown, but also coming off of the volatility that we saw in the fourth quarter of 2018. So again, you saw companies queuing up because on a 10, 11-year bull market, they're starting to wonder, is the window perhaps going to close? So should we be ready? So what we heard from companies throughout the year was they wanted to be ready to go. In the second half of the year, it was a slightly different story. Investors, for a number of reasons, started asking questions they hadn't been asking for a while. So,
like, where are the profits?
Like, where are the profits? Or how are you going to get to the profits? I think investors do have an appetite for a company that's not yet profitable, but they want to know what their plan is. And it was no longer growth at all costs. And not just about profits, which I think was an important question for investors to be asking, but also about governance and discipline. And there are a lot of things that we've been asked by investors to take a stand on. And where I really think we saw the pivot in the end of the year was investors saying, we have the money. We can take this stand, because our view is investors should have access to the vast majority of opportunities, and then they should vote with their money, because it's really important that we not deny them of those opportunities, but they need to use their vote. They are the ones with the cash. And so what we saw now coming into 2020 is investors are asking a lot tougher questions of companies, and you're seeing they're asking more about the valuations, and I think that's a good correction for the market, because we want to make sure that the public markets don't become just an exit strategy, that they're still a growth strategy. And the valuations from the private markets are just a starting point. Nothing values a company better than the public markets, especially here in the U.S. And so we have a very strong pipeline of companies lined up to come out. And as we see investors start to reward those that have the stories that make sense with a path to profitability and good governance and good discipline, and they perform well, I think you'll see the window continue to open.
Yeah, the exchange recently modernized its rules to allow companies that are not profitable yet to list here. And I'd imagine that opens up a lot more business opportunities for the exchange. But at the end of the day, is it really in the investor's best interest to help companies that are not yet profitable go public?
Yeah, I think it's in the investor's best interest to have access to those opportunities and to be informed about what the real data is. And if you think about companies that have come public pre-profitability, they have that growth very, very rapidly, and you want to make sure investors have access to those rapid growth years earlier in their life cycle. A company I like to highlight, you look at Salesforce. It became public just over 15 years ago, and they're up a tremendous amount, 3,300% more than that since their IPO, and that compares to less than 200% in the S&P 500. We want investors to have access to those opportunities, but to be educated and informed on what the real data is and what the prospects are for a company. So I do think it's important.
I'm sure you can't speak specifically to a company, but I mean, certainly our viewers know all about WeWork, having been sort of the poster child of how not to try to go public, a company that was not profitable, had governance issues. What do you hope investors have learned from the IPO that wasn't in WeWork?
I think it's important to recognize that the trends we're seeing in our market aren't about one company. Now, one company may have started the conversation much more effectively, but I think it's important that we recognize there were issues that needed to be addressed in the market. Investors needed to be asking questions about valuations. The fact that companies are growing so much in the private market space leads to a number of issues. One, if they have bad habits, they're growing with the company. And so the public markets add that layer of discipline and governance that the private markets just don't. Two, their valuations are reflective of a smaller universe, and having one or two investors really determining what the current valuation of as a company is not the same as having hundreds of buyers and sellers coming together. And those valuations we want to make sure are based on facts and reality, and not just, in a best case, limited information, at a worst case, intentional mismarking. And then third, that fact that they're staying private longer is also contributing to the bifurcation of wealth, as we've seen these opportunities denied. So we saw in the second half of the year, a company really trigger those questions, and I think that's good for the market that we're asking those questions now, and I think ultimately we'll be better off.
What about direct listings? You had a couple of successful ones here. Do you think that we're going to be seeing more of that, and why?
Direct listings are a really interesting innovation in the U.S. capital markets, and part of why we developed the direct listing offering and that product was because we talked to our customers, and we heard from them, hey, I don't need to raise money, but I want to be a public company. I can get money in the private markets, but I want to be public. And I think that's an important idea to say, let's take a step back and think about how are we doing things, and do we have to keep doing them the same way just because we've always done it this way, or at least we've done it this way for the past 40 years.
Right, right.
The modern IPO is not that old. And so when we asked ourselves that question, and in consultation with our customers and their advisors, we decided, hey, no, you can decouple capital raising from the public listing. And so we did that. We started first off, working with Spotify, and it was really Barry McCarthy, who was the CFO of Spotify.
Did he actually come to you and say, hey, we want to do this?
He came to us and he said, hey, I have an idea. I'm not ready to talk about it publicly yet, but what do you think about it? And so we iterated on it, and we came up with a way that we thought we could make it work, and we worked with them and the SEC and their law firms and their advisors, and it took about a year and a half to actually get that first one live, and Spotify traded with less volatility because what's really great about a direct listing is it democratizes access on day one. So if you think about an IPO, what happens at an IPO is a company is working with their banks, and they're selling an allocation out to a handful of investors, and they're targeted investors the night before, and that's their initial offering, and then the market is valuing it the next day in the public space. But not everybody gets to trade initially. There are lockups, and so you don't really get to a place where the trading of a stock is not artificially constrained until 6 months down the road. In an IPO, you're really, in a direct listing, you're really bringing together buyers and sellers uninhibited out of the gate. And what we've seen, which is really interesting, in both Spotify and Slack, the two direct listings to date, their opening trades were the largest of all time, despite the fact they weren't the largest companies of all time. So Slack had more volume and more dollars traded in their opening print. It was the third largest opening trade in the history of the U.S. markets.
Wow. I mean, look, these underwriters make a lot of money off the IPOs. It's very lucrative for them. When you direct list, you're basically cutting out the underwriter, are you?
You're changing the role of the banks. I think there still is an opportunity for the banks to assist the companies. And one of the things you often hear is that in a direct listing, you're not doing a roadshow. They do an investor day instead that's televised. That's actually not true. you can do both. And so the banks can still play a role in helping companies develop relationships. And I think you'll continue to see that evolve. And I think you'll see not just, I think you'll see financial advisors work more closely with these companies as they explore the direct listing path. So the next step that the New York Stock Exchange took was to allow for you to actually raise capital that way as well. And so we filed with the SEC, and so pending their approval, and I expect we'll go back and forth with them on a few things as we did before, but our goal is to allow another tool for companies to raise money and let the markets determine their value.
Are you concerned at all that going public has sort of been used as a tool, as an exit strategy, as opposed to a growth strategy for a company? And what can you do to change that?
Yeah, that is a concerning trend if companies wait too long to go public, because you don't want the public markets are not going to just pick up leftovers forever, right? We want to make sure that they're part of the success story and part of the growth of a company. And, I think we very often hear about some of the high profile companies and it might skew the narrative a little bit. IPOs in 2019 are up roughly 20%, right? So there is a good story still, but we want to make sure that we aren't leaving too much on the table for the everyday investor.
Do you expect a number like that in 2020, that IPOs will grow in that same way?
Yeah, especially now, because I think investors are asking tougher questions. Yeah. So I think you will see some additional diligence on what the valuations are in the private markets before we price.
Something else we're expecting in the new year is more consolidation in the brokerage industry. We had Schwab buying Ameritrade for $26 billion. They're going to have $5 trillion in assets. How, if at all, does a shrinking brokerage industry impact your business?
I think if you look at technology, and one thing technology does is allows you to scale. And every industry takes advantage of the fact that you can scale with technology. We certainly have here at the New York Stock Exchange. And so what we'll see is when you have technology and you can scale, consolidation very often makes sense because you can leverage that technology footprint. So that's not an unusual or new thing for the industry. We've been seeing that trend over decades.
Mm-hmm. Are you doing anything differently to sort of stay competitive as the industry continues to get smaller?
We need to make sure that we're providing the best possible service to our customers every single day. So we've completely changed over our technology platform to meet the needs of our customers in even a more effective way. It's a state-of-the-art platform, and we process over 80 billion messages a day. You certainly couldn't do that when I was on the trading floor as a human being and a specialist. So certainly technology is a big part, and that's a constant evolution.
You mentioned being on the floor as a specialist. Back then it was for B of A, Bank of America. This was in the 90s, right? Mid-90s.
And early 2000s too, yeah.
I was on the floor as well. We didn't know each other, but I was one of the first reporters on the floor of the exchange, and you were down there as a specialist, having started out here as an intern, we should mention, and you've worked your way up to president now. But we can both agree that the energy here is different. Things have certainly changed over the decades, as they should. What are you doing in your role now to keep the exchange relevant, especially in the digital age?
Yeah, the sounds have changed. So we replaced a lot of the shouting with a lot of beeping. So if you hear all the technology sounds on the floor, there are orders coming in electronically. So I would say the soundtrack for the exchange has changed a bit. Roughly 20% of our provided volume comes from the trading floor. The fact that we have the combination of people and technology means our stocks trade with less volatility. We've automated the parts that ought to be automated, and we've allowed people to scale their functions so they can focus where their judgment is most impactful. And as a result, our stocks trade with less volatility, especially during times of overall market volatility. So, we touched on the fourth quarter of last year. During that period of time, our spreads widened out by 40% less than other fully electronic exchanges, because we wanted to make sure, because of the model that we put in place, so that we're always providing the best result for our listed companies, and that translates into cost savings for their investors. So making sure that we always have that right balance, again, coming back to balance of human judgment with sophisticated technology, is the best thing we can do for our customers.
This is a beautiful, iconic building. It's a lot of real estate, a lot of space. Do you foresee yourself needing this kind of space in this decade?
Yeah, I absolutely think that we continue to evolve. The way we leverage this building and this footprint has changed for sure over the years. Like I said, because technology has allowed us to scale, it allows us to operate the trading floor in a smaller footprint and turn more of the building into space that our customers can use. So our listed companies, we held over 2,500 events here last year, and that's something we can give back to our companies that are listed here as sharing this iconic building with them.
Now, outside of your life here at the Exchange, for a brief time you went to culinary school, which I find fascinating because I actually, somewhere at some point in my life, I need to do the same thing.
It's fun. I highly recommend it.
You didn't make a living at it. You said you didn't go into it with that purpose in mind, but I'm curious, do you cook a lot? And if so, what's your favorite thing to cook?
You know, I love to cook, and when I went to culinary school, I knew I was always going to love to eat. So it wasn't a skill that was going to go to waste.
Right.
So I prefer slow cooking. So I very often like doing a lot of slow summer cooking, some barbecue.
Oh, sounds good. Do you do holidays at all for the families?
I do the family holidays, and I'm come from a very large family, so that means cooking for a lot with very curated menus on everybody's allergies and everything else we have.
Right. Oh, that's awesome. So you have a very busy life both in and outside the Exchange. Give us Stacey Cunningham's life hack. How do you do it?
My life hack is I think you need to rise above it every so often and think about, are you focusing on the right things? And that touch point, just kind of taking a step back and thinking, am I spending my time in the right place? Am I focused on the areas that are really going to help our customers and our stakeholders more broadly? And those are the things that I think having that touch point of knowing how you feel like you should be splitting up your time and then touching base to make sure you're still doing that, I think has been helpful for me.
Do you do it all on your phone? How do you stay organized?
I do a lot on my phone. I have an app that I use. There's an app called Things.
Okay.
I like that one. It keeps me on track.
All right, I'll have to check it out. Stacey Cunningham, thanks so much for your time today.
Great. Thank you so much, Alexis.
Appreciate it.